Let's bring in Scott Diamond now. He's the co-head of fixed income over at Goldman Sachs Global Asset Management. Scott, great to talk with you this morning. Let's start with rates at the long end and how they've impacted your thinking on where you're putting money to work, what clients are asking, and what this environment really does for the opportunities that you guys are looking at in your funds.
Sure, terrific. Good morning, everyone. Great question. With the yield curve steepening, I think it's probably beneficial for a lot of fixed income investors. It's been what everyone has waited for. I don't know how many clients we've spoken to that would say yields are just too low. How can I engage the market? Well, here's your opportunity. As the head of our fixed income just recently said, with rates going higher, with the yield curve steepening, bond investors pretty much just got a raise.
Hey, Scott, Brian Trunk here. So I guess the question, though, is going to be how have the movements on the longer end affected the spread between U.S. Treasuries and municipal bonds? It seems like everyone's been really fixated on just what's happening in the rates market, but obviously that has lots of implications for different types of fixed income as well. So what are you specifically seeing and how the dynamics changed as we've watched that narrative of higher rates over, let's say, the last 4 weeks?
Yeah, really good question. And you're right. Municipals, fixed income product, we're supposed to pay attention to the Treasury market, and we do. Under most market environments, we're going to take our lead from the Treasury market. If Treasury yields go higher, muni yields are supposed to go higher as well. If Treasury yields go lower, we'll follow suit. We haven't really done that. And quite frankly, I think it's because if you look at, not the Fed dots, but maybe the muni dots, we actually have a lot of really positive things that have gone on in the municipal bond market. Muni credit has actually done really well. We're seeing tax receipts come in many states better than expectation, better than budget. They've been much more resilient over the course of the last year, which is we're starting to see in their financial numbers. Let's add to that things that have gone on in Washington, D.C. This most recent round of stimulus will help the states and local governments. It will help universities, education. It will help some transportation sectors. It will help airports. So all in, the backdrop for munis looks really good. And we're starting to see that expressed through demand for the asset class. Demand has been quite robust. Investors are willing to allocate to the municipal bond market. Supply has not been a burden for us. Any supply that has managed to find its way into munis has been very easily absorbed. And so all in, that very positive technical backdrop coupled with very strong credit fundamentals mean that we haven't really behaved like I would have ordinarily expected us to as that Treasury yield curve has moved a little bit higher.
Scott, I follow Goldman's equities research very closely. So very bullish on the S&P 500 in equities, bullish on the economic recovery. How is that bullishness translated to your side of the business? What changes have you made recently to the fixed income side of the portfolio?
Well, almost separate from those expectations on the equity side, if I look at the municipal bond market, we had massive disruption, of course, like most asset classes last year with the pandemic. We spent 2020 kind of recovering, getting back to normal. But if I look at the municipal bond market today, parts of our market that have not really fully recovered are going to be in that mid-grade to low-grade portions of our market. If I look at the triple B space in munis, those spreads still look pretty attractive relative to where they've been historically, relative to where they were pre-pandemic. If I think about the high yield portion of our market, there are portions of our market that struggled pre-pandemic. Frankly, I would expect them to continue to struggle post-pandemic. But there are a number of sectors in the high yield muni space that really got hit hard because of the pandemic. And I would think that as we get closer to more folks getting vaccinated, as we start to return to a more normal, whatever new normal is, as we return to normal, I think that has the potential to really help some of those high yield sectors. So I like that portion of the market. I think that there's still relative value opportunities. I think you need to do your credit homework to find the right credits to get invested in, but just be patient. They're going to be there.
Scott, now you talk about high yield, but what specific types of flavors maybe of just broad municipal bonds are kind of the most attractive in your view as a general obligation? Is it the revenue bonds? Is it taxable, non-taxable? Where are the places to go right here?
Oh, wow. That's a great question. And part of the reason I love the muni market, right? Because we have so many options like that. I would say that, the GOs are looking really strong. Tax receipts coming in, I guess all in, maybe we're down 2.5% on average post-pandemic. That's actually pretty good, pretty resilient. But I think a lot of that's priced into that segment of the market. You raised a really interesting component of our market, taxable municipal bonds. So they're the same issuers that we would typically see in the tax exempt space, but for a variety of reasons, they need to issue in the taxable market. Taxable market will price the same as corporate bonds. Taxable munis at treasuries plus a credit spread. It's actually become a much bigger portion of our market. Last year, it was probably about 30%. So what's interesting about that? I think two things. Number one, the tax exempt supply has not really changed. It's running about average. And yet we're seeing tremendous demand for the asset class. And so the valuations on those tax exempt munis have gotten pretty rich. So maybe that's not the smartest use of our next dollar to invest. Taxable munis, it seems as though it's a temporary increase, and that's caused a massive amount of supply. Those spreads actually look very compelling. So depending on an individual's tax rate, you could actually buy a taxable municipal bond, adjust that to assume that you're going to pay taxes on that, look at that net yield, and then compare it to that same issuer's tax exempt debt. You could actually come out ahead. So I think that in this market, apart from being very selective in credit, be very efficient, try to be more nimble, go to wherever the best tax or after-tax yields you can find, be flexible, and you may be surprised at where that opportunity is going to be.
All right. Really interesting conversation, and certainly something different than our usual fare on, where is stock X going from here. Scott Diamond, co-head of fixed income over at Goldman Sachs Asset Management. Appreciate the time. Brian Chung, thanks for jumping on as well. I know we'll talk to you, Brian Chung, tomorrow during All That Fed Hoop